In today's fast-changing world, the stock market can feel unpredictable, even overwhelming. One day prices are soaring, and the next day everything seems to be crashing. But here's the truth that successful investors understand: the market is not about guessing, it's about strategy. Welcome back to the channel. Today, we're breaking down how smart investors make money in any economic condition, whether the market is going up, down, or moving sideways. Let's start with the basics. The stock market is driven by two key emotions: fear and greed. When investors are greedy, prices rise. When fear takes over, prices fall. Smart investors don't follow the crowd, they do the opposite. They buy when others are fearful and sell when others are overly confident. One of the most important strategies is diversification. Instead of putting all your money into one stock, smart investors spread their investments across different sectors like technology, healthcare, energy, and finance. This reduces risk and increases the chances of long-term gains. Another key principle is long-term thinking. Many beginners try to make quick profits by day trading or chasing trends. While this can work for some, it's extremely risky. The most successful investors focus on long-term growth. They invest in strong companies with solid fundamentals and hold their positions for years. Now let's talk about market downturns. When the market crashes, most people panic and sell at a loss. But experienced investors see this as an opportunity. They understand that market corrections are a normal part of the cycle. Instead of running away, they look for undervalued stocks and buy them at discounted prices. Dollar cost averaging is another powerful strategy. This means investing a fixed amount of money regularly, regardless of market conditions. Over time, this approach reduces the impact of volatility and helps build wealth steadily. Let's not forget about risk management. Smart investors never risk all their capital on a single trade. They set stop-loss levels to protect their investments and always have a clear plan before entering the market. It's also important to stay informed. Economic factors like interest rates, inflation, and global events can significantly impact the stock market. Keeping up with financial news and understanding these trends can give you a major advantage. One mistake many people make is following hype. Social media and news headlines often create excitement around certain stocks, but not all of them are good investments. Smart investors do their own research. They analyze company earnings, growth potential, and overall market conditions before making decisions. Patience is another key factor. Building wealth in the stock market doesn't happen overnight. It takes time, discipline, and consistency. Those who stay committed to their strategy are the ones who see real results. Finally, remember this: there is no perfect time to invest. Waiting for the right moment often leads to missed opportunities. The best time to start investing is when you are financially ready and have a clear plan. To sum it up, successful investing is not about luck, it's about knowledge, discipline, and strategy. By diversifying your portfolio, thinking long-term, managing risk, and staying informed, you can navigate any market condition with confidence. If you found this video helpful, make sure to like, subscribe, and share it with others who want to grow their financial future. Let me know in the comments: what's your biggest challenge when it comes to investing? Thanks for watching, and I'll see you in the next video.